Welcome to this week's Lucia Capital Group Weekly video. Have you ever heard about the 0% tax bracket? It does exist, although not officially. Now here's the deal. If you look up the federal income tax brackets and tax rates online for 2021, you might find a table that looks something like this. You'll see a 10% bracket, then a 12, 22, and so on, all the way up to 37% for those whose taxable incomes is above $500,000 or $600,000, depending upon their filing status. So the first 20 grand or so of taxable income for a joint return is taxed at a 10% rate. Then the next chunk of 61,000 or so of income is taxed at 12% and on up. Once your taxable income is calculated, a tax rate is applied to each one of those dollars. Now remember, I said taxable income. That income is less than your total gross income because not all of your income is taxed. Look at it this way. You have your gross income, then you have your adjusted gross income, then you have your taxable income below that. But right in between the adjusted gross income and the taxable income, there's one of two things, either a standard deduction or your itemized deductions. And you get to reduce your adjusted gross income by that standard or itemized amount. In other words, that chunk of income is yours to keep tax-free. Technically speaking, although it doesn't exist officially, that income falls in a 0% tax bracket. Let's take a hypothetical married couple with $100,000 of gross income. We'll keep it simple. They have no 401k, no other deductions anywhere. It's just $100,000 of adjusted gross income for the year. They went online, found the tax table I showed you earlier, and ran the calculations. 10% of the first approximately 20 grand, 12% of the next 61 grand, and 22% of the last 19 or so. Add it all up, and they figure their tax bill is just shy of $13,500 on that $100,000 of income. That's a 13.5% overall rate. But their calculations in this case would be wrong. Why? Because our hypothetical couple is allowed to deduct just over $25,000 this year and have that amount of income tax-free, a 0% rate. They should have figured the tax on $75,000 of taxable income, the 100 grand minus the $25,000 standard deduction. By the way, if you're 65 or older, you get an even larger deduction. Now, when you run those numbers, their tax bill is considerably lower, roughly $8,600, not $13,500. This is because with $75,000 of taxable income, none of it falls in the 22% bracket, and it even gives you a little bit of room left in the 12% bracket. Now at that point, with about $5,000 of room left in the 12% bracket, you may want to consider removing some of the money from your 401k or traditional taxable IRA. Sure, you'll pay taxes on it, but you'll have to pay taxes on it eventually anyway, and unless you think tax rates will be lower in the future, that 12% rate might look pretty good. Your advisor can help you with your options. Now my point here is that it can be a really good idea to use the tax brackets to your advantage whenever you can. If you've got a tax-free opportunity, take it. Or if you're in a window of time where you can pay lower taxes now than you will in the future, use it. Tax management is one of the things we do here every single day at Lucia Capital Group. It's all part of the planning process. If you want to know more about how a tax management strategy may benefit you, just give us a call. We're here to help.